Okay, good morning, you beautiful human beings. I'm feeling a little bit better, not fully recovered yet, but I've been up since 3 this morning. I've been pondering very deeply about a particular subject that we've been following very, very closely earlier on and towards the middle of this year. We decided to reopen up the dusty old books on, and it's very, very exciting. I think there's going to be a ton of opportunities going to evolve from this discussion. So please, as always, leave your feedback. Let us know how you're finding this information, if it's easy enough to process. We are going to keep it light today, right? We're going to do, we've discussed this in great detail. We've probably spent, 30, 40 hours over the space of the last 2 years really discussing the subject. So there's a lot of information. I'm going to try and condense it as best I can. So please follow along. Love to hear your comments. Love to hear your feedback. As always, down in the video below, let us know. Now, again, if you're not part of our new social area, please go ahead, jump in. It is free. And we will be discussing this in a little bit more detail to get your opinions there. But in essence, what we're going to be doing is we're going to be unpacking the age-old discussion of interest rates, COVID, post-COVID, post-pandemic, etc. And we're going to be breaking this down, right? So for this, what we're going to be doing is we're going to be jumping in today and having a look at the US interest rate increases, right? Now, for those of you who've sort of been living under a rock for the last couple of years, and again, I wouldn't even blame you if you have been. It's just been a crazy time to be alive and in the world. I'm going to give you a quick summary of just kind of what you need to know, right? So again, COVID happened, the pandemic happened, the world freaked out, the world shut down, right? Now, what generally happens in these particular times is first world countries like the US, like the UK, what they will do is they'll start to immediately bolster the economy by offering incentive, by offering aid to workers, to compensate businesses and people not able to fully function. Basically, they just stimulate the economy, right? While they do that, what they do is they drop interest rates, right? So if, it costs you 5% to lend R1 million, they'll drop that down to 2%, 3%, 1%. And what they're doing is they're essentially incentivizing people to go out and lend money very, very cheaply. Now, when people lend money cheaply, what happens? They spend it. So they re-stimulate the economy. This is all obviously to make sure the wheels of the bus don't fall off, right? When you have these complex, massive economies, these living financial organisms, they require stimulation. They require work to happen in order to survive. So in any event, COVID happens, everyone panics, everyone's stuck at home. Governments around the world, primarily in this particular case, the US government, stimulates the economy by injecting a bunch of money into the economy. Lowers interest rates, making acquiring credit super, super easy. And Americans having a time of their lives, right? You guys remember there's times where most Americans, their stimulus checks were higher than the money that they were actually making. And so this caused a bunch of issues in the economy, right? A labor shortage in the sense that people just don't want to go back to work, etc. But what ends up happening when you just stimulate, when you just print and throw in a bunch of money into an economy? Now, this is not an old thing, right? This is called quantitative easing. If you want to jump in and research, just type in quantitative easing. You might be able to type in just QE and you'll get a bunch of information, as well as quantitative tightening, which is on the other end. But basically what this means is economies just print as much money as they want. They chuck it into a system. The problem with this is that when you're just printing money, is you're making the existing money less valuable, right? And this is what happens. And this is essentially what the government's trying to fight in terms of inflation. Now, excessive versions of this will be like what we saw in Zimbabwe, where, hyperinflation ran, where, a loaf of bread cost a few dollars, then $100s, then 1,000, then $1 million, then $1 billion, to the point where, a packaged fresh stack of money, whatever it may have been, 100 million or billion dollars, couldn't even buy a loaf of bread. And so when hyperinflation kicks in, economies and, their systems they're built on can be destroyed. So every government around the world, may jump in at times of need, make access to money easier by lowering inflation or lowering interest rates, and then just injecting a bunch of money. But in order to curb inflation, they need to then compensate for that. And what does that mean, right? So if we look at this graph behind us, right, this is the federal funds rate, right? And this is data that's freely available. I'll put the link of these charts. And you can go back as far as you'd love to and go and jump into some of these studies. It's a really amazing thing to go jump into. But essentially, here is what we saw in terms of COVID, right? So the US was generally steadily sort of rising the federal funds rate, all right? Generally just steadily ticking slightly up. And then obviously COVID hit and, again, just dropped it as quickly as humanly possible. So, in the space of a month or two, basically dropped it to basically nothing. Now, remember, federal funds rate is that base interest rate. There's another, systems and percentages that come over that, but for this particular purpose, we're just looking at the federal funds rate. So what happens, we essentially have, just over, let's say 2 years of basically zero or even below zero in some cases interest rates for the US, and the US is stimulated. But then 2022, right, the US now needs to raise interest rates. Now, firstly, before we take a step further, I just want to speak about what happens when, a government or a country drops interest rates. What does this mean? Right, so first thing you need to understand is when interest rates are dropped, it becomes less attractive to foreign investment. Why? Because it simply means that if I'm investing, $1,000 into a US economy, into US bonds, yields, treasury notes, etc., right, when interest rates are high, I'm receiving a higher dividend for the money that I'm putting in. When interest rates are dropped, what it essentially does is it says that, hey, the money that I'm putting in there is just not as attractive, as an example, right? And that is why you'll see developing or third world countries, etc., like Southern Africa, there's fairly high interest rates, again, to attract that foreign investment, to attract that, people dropping money into that economy. But in the US's case, essentially interest rates are dropped or too low. That basically causes people to pull money out of the US and look for other alternatives. Now, yes, in times of crisis, that's not always 100% true, but that's generally the rule. Low interest rates mean just not as attractive. Maybe super stable, yes, not as attractive. So what happens is when interest rates drop, right, the dollar tends to suffer, right? It tends to suffer a bit, while we see other commodities, other areas like gold, like Wall Street, US 30, US 100, NASDAQ, these types of things, these things get stimulated. Why? Because again, US consumers are spending more. They're being given all these stimulus checks. They're being given lower interest rates to borrow money, and they're re-spending that money on the stock market. In addition to that, and as another keynote, which is going to become more important later on as we go down this topic or down this road, is that when the federal funds rate is lower, right, that means that government bonds, government yields, treasuries, right, these are less and less attractive. So something like Wall Street, the stock market, becomes far more attractive because it's higher yielding, higher rates there, as opposed to a steady, secure, super low interest rate from a government, right? So what we need to understand here is that when interest rates drop, the dollar tends to drop too, right? When interest rates start to rise, what ends up happening here, right? Now, if we have a look at, once the 2-year cycle had come past and, the US government had stimulated the economy enough to the point where economists are worried about inflation, again, $1 today buying less and less tomorrow, they started to ramp up interest rates, right? Now, again, opposite of cooling down or taking off interest rates, what does this mean? Well, when you start to ramp up interest rates, you start to make government assets more and more attractive, because here you have this first world country, seems to be done the right things in terms of stimulating the economy. They're now raising interest rates. This becomes very attractive in terms of government-backed treasuries and securities, right? But what this does is it makes Wall Street less attractive, right? Because now you've got this government-backed secured item that is going to give you more and more interest as governments raise interest rates. Now, in line with raising interest rates, what does this do? It basically starves the economy of cheap capital, of cheap cash, right? When you raise interest rates, it means that if you went to the bank today, right, when interest rates are flat, that you'll be able to get cheap credit. Tomorrow, if they raise interest rates and you go tomorrow and you ask for the same amount of credit, your repayments will be higher. And in most cases, people then wouldn't just borrow as much. So it's a tool to constrict or contract the economy. But what we need to know and what we're going to focus on for today is that higher interest rates, right, stimulates the dollar. Lower interest rates tends to not stimulate the dollar. Dollar tends to lose a bit of a value, and the money tends to get redirected elsewhere where it is far more attractive. So if we're on the same page, then I want you just to give me a nods up, hands up in the comments down below. So most importantly, right, we can kind of see that from the start of 2022, those interest rates started to ramp up. Now, very, very interestingly, if we go into the markets, and I'm going to talk about the dollar index for a second, but primarily if we just look at NASDAQ, if we just look at US 30, we're going to start off on NASDAQ. You guys will remember that 2022, this is NASDAQ on a daily time frame, otherwise also known as US 100 or USA 100, or also NAS 100, right? 2022 was probably the worst year in Wall Street in a very, very long time. right? And why is that, right? Many people just don't know or don't understand why NASDAQ fell off a cliff after having performed so well post-COVID, right? Just behind my face, if I move over, just over there, right? Just this area over here, that was COVID, guys. That was what the pandemic did to the stock market. Basically nothing in the relation or in totality of things. And then we just saw the market just absolutely rally and chew it all up. What happened? Very, very simply put, the US government started to raise interest rates, right? Making things like Wall Street less and less attractive and making what? Government bonds, government yields, treasuries a lot more attractive. Now, where are we right now in this whole discussion? Right? Two things, right? Basically, we hit a peak towards the end of last year, right? Already at the end of last year, at the end of 2022, right? The government basically said, the US government said, hey, listen, we're seeing all the right signs to start just being less aggressive on raising interest rates, right? So that was the sort of discussions that were happening in this area. And Wall Street started to take that as, okay, listen, this is good. This is great. We now, we're good to go. We're going to start to see the numbers trickle through. And as you guys remember, it hasn't always been the case, right? Over the course of 2023, we've seen higher than expected inflation readings. We've seen a bunch of chaos across the markets. And this has kind of led a lot of the markets to really sort of teeter and go, well, is this data correct? The Federal Reserve is putting in these measures, increasing interest rates, creating certain financial policies to slow the economy down. But the economy looked red hot. We saw, massive CPI, PPI, retail sales numbers over 2023. And it was kind of shaky as to, where was this going and where would this ultimately end up? Now, we are in a completely different time and space. And that's why, I've been up since 3. I've been looking at the markets and I decided to go through some old notes, what we were really focusing on in the middle of this year, beginning of this year, etc. And, I stumbled upon this dollar index that we largely have kind of given up on, or not necessarily given up on, but we've looked past completely for one simple fact, right? If we look at the dollar index, right? And again, what are we seeing here? Right, we're seeing that stimulation of, raising of interest rates. Dollar has performed. And again, at the end of 2022, when it kind of signaled, the Fed signaled, hey, enough is being done, the dollar started to really suffer here, right? And at this point, as traders, we kind of really started to identify that, we've kind of broken this market structure. Very, very clearly, we can see the dollar's strength has been broken at this point, but we started to establish this trend that was happening, right? Now, when we got to the end of August, primarily the beginning of September, right, and I believe largely why we've kind of forgotten about this index, or at least the story of price or this inflation story, is that when we got to the end of August, beginning of September, it was largely expected that we would start to see that dollar sell off at that point, right? If you guys are with us, if you DVDM markets veterans, that's exactly what we were thinking about there. And then we saw that little bit of a push up and we're like, all right, fine, this next push, not an issue. We might be pushing to that level. And then we saw another push up and we're like, okay, this is kind of becoming an issue. Ultimately, what we ended up seeing is that at the end, or towards the middle towards the end of last month, really what we've seen here is the dollar index is kind of really just stalled out completely, right? And with NFP, with CPI, with a lot of this new data that we're seeing, this is kind of cementing kind of in stone to say, hey, the measures that the Federal Reserve's put in place to raise interest rates, right? Those are primarily the biggest measures, right? They've slowed down the economy enough, right? We're seeing the data starting to come through in terms of CPI, PPI, employment data, etc. Those are all starting to show signs that these efforts are now valid. What is the next season, right? And that's really what I want to speak about today, is what does this next season mean? If all these efforts have been good and they've worked, what does it mean for the future of the dollar? What does it mean for the future of stock markets, Wall Street? Well, as evidence shows, and as we've seen in the past, right, when heightened levels of interest rates have been held for too long, and then they end up starting to come down, what happens is investors that were jumping into government bonds, why? Because the yields were high, because interest rates were high. As soon as that interest rates start to pause or start to signal that they may start to reverse in the coming months, coming year, what happens is investors take their profit, because again, they got these high yields, they got this high earning interest rate items, and they start to look for other areas to put their money in, right? In addition to that, when you start to lower interest rates, you start to remove that pressure off of the US economy and primarily off of US consumers, allowing US consumers to have more in their pockets to be able to spend more, to basically re-stimulate the economy more. And that is essentially what we see, is that monies get redirected. And again, S&P 500, if we look at US 30, Dow Jones, we look at NASDAQ, these are all some of the biggest publicly traded companies in the world. When consumers spend more, they generally spend more on these companies, right? And their share prices, their evaluations, their forecasts, their estimates, their quarterly earnings start to tick higher, and this generally pulls the rest of the market with it. So where are we, and where do I think we are busy going? Right, now that we've seen the data, markets have made their false move towards the top side and have come back into market expectations, I believe we are very, very clearly in a very good place right now. Not necessarily today, not necessarily tomorrow, but the fact that the dollar index is broken down below this 103.40 mark, right, which is what I was really speaking about with quite a bit of intensity, 104 flat mark towards that end of August, September level, right? I do believe we might make a little bit of a play here, right? A little bit of a play over the next day or two, maybe even over this coming week, that may push the dollar slightly higher. However, it works out perfectly in our favor, right? Having a look at NASDAQ, going back to NASDAQ really quickly, you'll see that NASDAQ, if we just, and I mean, we're not going to get too deep into this, I've been spending quite a few hours on analysis and back testing, etc. But what I just want you to see here is that on that 2022 sell-off, right, that worst year in, let's say, Wall Street history in the last couple of years, that has largely been made up. We're above that 88.2 fib level, meaning we've made up 88.2% of the loss for that 2020 mark. Now, again, also want to point out that we have broken through that 88.2, and there's quite a bit of value here that needs to come back and at least sort of pull down to. So at least on NASDAQ, and it's going to show a very similar type of thing here, at least on a 4-hour time frame, there's definitely space to pull back down to. Now, I'm very, very keen on getting fairly bullish above that 16,000 mark, so 16000.00 on the NASDAQ, because again, that would prove that we have settled above that 88.2, provided that on the dollar index we've made some sort of pullback into this zone, and then we show signs of a continuation towards the downside, and on NASDAQ we show signs of holding up above support and continuations to the top side. A very, very similar story is then also visible on the US 30. So there's our 2022 worst year in the financial markets. January, really the actual breaking points kind of sits at January 2023, but January, February, March, both for the NASDAQ as well as the US 30 is that confirmed retest, right? So if I have a look at NASDAQ, I want to quickly show you guys this. Right, so we have a look at January, February, March 2023. We've got the breakout, we've got the retouch down there for both NASDAQ as well as US 30, right? That is that confirmation right there. But in terms of this last bearish season we've had a very similar type of bear season, right? Again, looking at around about July, August, we've had this bear market for both the US 30 as well as NASDAQ, right? So there, if we have a look at July, August, there's that little bit of bear market, and we've officially only broke out of that bear market into bull structure, official bull territory, after the first week of this month. So after the 6th of November, we've broken out into official bull territory for both the NASDAQ as well as the US 100, and a very similar type of thing has been formed and is confirmed too when we look at gold, right? When we look at gold, we've officially sort of bottomed out at the 1931 mark in terms of this last little bear pullback, and now we're moving into solid bull territory. One may argue it may even be as far back as the 16th. We've moved out of this channel, right? So on the 16th we moved out of this channel, 13th really, 16th, and now we're in this new state of bull market, right? So across the board, I think for NASDAQ, I think for US 30 as well as some commodities, there is massive opportunity to get long. However, I do suspect on the dollar index, we are going to receive some sort of pullback, right? Not everything that goes down just continues down in a straight line. We know this in markets. We receive, an impulse, a correction, impulse, and correction. Now, it looks like we've seen the latest impulse. We need some sort of correction here, right? And I would really like to see, the dollar kind of regain to, some previous level here. So ideally, I'd like to see the dollar make some sort of pullback into this 103.70 mark. 103.70 before we get that next leg or next extension towards downside, right? That would be extremely interesting. And if the price action holds out, right, that we can still get long on US30, NASDAQ, gold, I'm officially into bull territory, very, very bullish right now on basically everything that is not the dollar, right? So everything that the dollar is the quote currency, I'm looking at bull opportunities, whether it be Euro USD, whether it be GBP USD, whether it be gold, whether it be NASDAQ, whether it be US30. These are all areas that I'm looking medium to long-term bullish on. Now, between now and then, it obviously means there is some scalping we can do, right? So there will be some interim buying and selling. There will be some short and long opportunities. That's just general scalping. There's nothing too scientific about that. I must also say we obviously have a brand new team. We've got new systems, we've got new technology, and things are proving to be a little bit harder than what I thought. And in a lot of these cases, in order to allow a team to thrive, you need to be a little bit more hands-off. Now, I've trained everybody, I've spent time with all the individual components of the new social area. But again, with that allows opportunity to fail. So things haven't been the exact way that I wanted from a signals perspective, the type of quality, the type of accuracy. However, I will be stepping in as I'm recovering this week and have a more hands-on approach to make sure the type of signals and quality that we put out there is something that is representative of what DVDM markets has been doing over the last many years or so. So you do get my personal word. I will be jumping in and sorting that out for you guys. Outside of that, this is just something I find extremely interesting. It's gone over, a little bit more than 10 minutes, probably close on the 20-minute mark. But I think super important that we all understand what phase and state that we are in. Because again, this ripple effect will happen around the world. Now, yes, there are external factors. There are some geopolitical issues. There are, the Israel, Gaza type issue that's happening at the moment. We still have Russia, Ukraine. That's still out. That's still playing on. We still have, external powers and forces that will continue to kind of meddle with the markets. But with that being said, we generally just follow the price action. This is what the price action is telling us. The price action is linking up to long-term data, long-term trends. Now, some of the most successful investors in the world, right? Whether you look at Ray Dalio, you look at any of these individuals, right? When you look at what is the main core reason for their success, right? And you can look at anybody, right? Anybody who's a veteran in the industry, 30, 40 years, who's built billions in funds, right? You ask them what's the number one key to success. And it's not that they're inventing anything new. It's not that they're developing a new strategy and branding it as this something traders, whatever the case may be. The core principle about what they say and what they advise, everything that's ever happened before is going to happen again. Everything that's going to happen has already happened before in one shape, sense, or place, right? So recessions, interest rates, increases, markets falling, markets rising, these things have all happened before. It's us, our job as traders, to go in there, put the time in, look at the data, understand what's happening in the world, look at different charts, look at different views, and try and compile that into an image that we understand to better or give us a further edge on our trading as a whole, right? And again, it's something I'm sharing with you guys, something I'm quite passionate about. It's understanding the markets. If you like that, if you've understood what I've said, leave a comment down below. So again, you want to stay tuned and make sure you do not miss out. Leave a comment down below. Get into our social area. If you're not yet a part of TD Markets, to have a pure STP live trading account, link is down below as well. That gets you a great discount on our Premium Plus, which is less than $1 a day, to receive everything we do and so much more, fully unlocked the full potential of DVDM markets. As always, guys, I appreciate you. I love you. Again, for Premium Plus subscribers, I will see you in dollars for lunch this afternoon. For the free environment, I will see you guys in pounds for breakfast again tomorrow. Your free dollars for lunch is on Wednesday afternoon. Outside of that, guys, as always, much love, be safe, trade safe. Until I see you a little bit later. Goodbye.